Welcome to Section 2 of the ASC 505 Equity Training Series. In this video, we are covering every major stock issuance scenario you will encounter in practice: issuance for cash, issuance for non-cash assets or services, basket issuances of multiple securities, and stock subscriptions where shares are committed before full payment is received. By the end, you will be able to record each scenario with confidence. After this section, you will be able to record stock issuance for cash, including the split between par value and additional paid-in capital, account for no par value stock, apply fair value measurement when shares are issued for non-cash consideration, allocate proceeds across multiple securities in a basket issuance, and correctly record and classify stock subscriptions and subscription receivables. Let us go through each scenario. Before we record a single journal entry, let us get the timing right, because this is where errors creep in. Shares are recognized on the books when they are legally issued. That requires two things to be true simultaneously. The board has approved the issuance, and the entity has received the consideration. Merely announcing a share offering or receiving a subscription commitment without cash is not enough to trigger recognition. Once both conditions are met, proceeds are split between two accounts: common stock at par value and additional paid-in capital for the excess. Here is the standard cash issuance. Your company issues 10,000 shares at $15 each with a par value of $1 per share. Total proceeds are $150,000. The entry is: debit cash for $150,000, credit common stock at par for $10,000, that is 10,000 shares times $1 par, and credit additional paid-in capital for $140,000, which is 10,000 shares times $14 over par. The rule is simple. Par value times shares issued goes to the common stock account, and everything above par goes to a PIC. This holds every time shares are issued for cash, regardless of the market price. Some states permit or require no par value stock. When there is no par value, the accounting is actually simpler. The entire proceeds go into one account: common stock. There is no need for an APIC line because there is no par value to separate from. Example: 5,000 shares issued at $20 each with no par value. Entry: debit cash for $100,000, credit common stock for $100,000. However, if the entity designates a stated value per share, think of this as a voluntary par value equivalent. Then the stated value times shares issued goes to common stock, and any excess above stated value goes to a PIC, exactly like the par value split. What happens when a company issues shares for something other than cash, say, for land, equipment, or professional services? The measurement principle is: record at the fair value of the consideration received. If the asset or service has a reliably determinable fair value, use that. If it does not, for example, highly specialized or illiquid assets, then fall back to the fair value of the shares issued, whichever is more reliably measurable. Here is an example. 500 shares are issued for legal services. The shares have a fair value of $20 each, so the services are valued at $10,000. Entry: debit service expense for $10,000, credit common stock at par for $500, 500 shares times $1 par, and credit a PIC for $9,500. A basket issuance occurs when two or more classes of securities, for example, bonds and warrants, or common and preferred shares, are sold together for a single combined price. You need to allocate that total price between the components. Two methods apply. The proportional method is used when both securities have known fair values. Each component gets a share of the total proceeds equal to its fair value divided by the sum of all known fair values. The incremental method is used when only one security has a reliably known fair value. Assign the known fair value to that security first, Then give the remainder of the proceeds to the other security. Let us work through the numbers. A bundle of bonds and warrants is sold for $100,000. The bond has a fair value of $60,000, and the warrant has a fair value of $15,000, giving a total known fair value of $75,000. Using the proportional method, bonds receive $60,000 divided by $75,000, multiplied by $100,000, which equals $80,000. Warrants receive $15,000 divided by $75,000, multiplied by $100,000, which equals $20,000. Notice that the allocated amounts do not equal the individual fair values. The allocation simply uses the ratio. The bond is allocated $80,000 even though its standalone fair value is $60,000, because the bundle commanded a premium. A stock subscription is an arrangement where the entity agrees to issue shares and the investor agrees to pay, but payment comes over time, not all at once. Think of it as a layaway plan for shares. The company makes a legal commitment to issue shares once full payment is received. Until then, the shares are not legally issued. You use a separate account called common stock subscribed to track the commitment on the equity side. The shares are only transferred from common stock, subscribed to common stock when the final payment comes in, and the shares are fully paid up. Here is the accounting treatment that surprises many practitioners. When a subscription is signed but full payment has not yet been received, you have a receivable, the amount still owed by the investor. The instinct is to record this as an asset on the balance sheet, like any other receivable. But US generally accepted accounting principles says no. A subscription receivable for shares not yet fully paid must be presented as contra equity, a deduction within the equity section, rather than as an asset. The reason is substance over form. The company has not actually received the economic resources. Recording an asset would overstate total assets and give a misleading impression of the company's financial position. Let us trace the full journal entry sequence for a subscription of $100,000 where 50% is paid up front. Initial entry: debit cash for $50,000, debit subscription receivable labeled as contra equity for $50,000, and credit common stock subscribed for $100,000. The receivable sits on the equity side as a negative. When the remaining $50,000 arrives, debit cash for $50,000, credit subscription receivable for $50,000 clearing that contra balance. Then immediately, debit common stock subscribed for $100,000 and credit common stock for $100,000. The shares are now legally issued. Let us recap. Shares are only recognized when legally issued. That requires both board approval and receipt of consideration. Every cash issuance splits proceeds between common stock at par value and additional paid-in capital. Non-cash issuances are measured at the fair value of what you received, or the fair value of the shares if the consideration is not reliably measurable. Basket issuances use either the proportional method when both fair values are known, or the incremental method when only one is known. And subscription receivables are contra equity under US generally accepted accounting principles, never assets. Thank you for completing this section on stock issuance, all scenarios. Thank you for watching. Subscribe for more training from PNJ Group.